I'm Helena Conradi, CEO of Satrix, and I'll be your host today. I'm very excited to welcome you to our first webinar under the Index More initiative. So what is Index More? It's an educational collaboration between Satrix, the leading index manager in South Africa, and BlackRock iShares, the largest ETF provider globally. The intention is to provide appropriate and targeted content to the South African investor, you, that speaks to more than just index investing, introducing the Index More concept. So in the next few months, we'll be presenting a broad range of topics, including China, ESG, and many more, leveraging off the insights of both ourselves and BlackRock. Today, we are starting the discussion with a focus on megatrends, structural shifts that are longer term in nature and have irreversible consequences for the world around us. BlackRock has come up with a list of 5 megatrends that they believe are likely to shape our global economic, political, and social landscape in the years to come. But before we begin, just some house rules. You have joined the call on mute and without video, so don't worry. So the way to engage with the discussion is to type your questions in the Q&A feature at the bottom of your screen. Only Rob and I can see your questions, and we will try to pick up on as many as possible at the end of the session. The webinar will be recorded and we'll send you a copy in the next few days. So no need to worry if you experience technical difficulties on your side or need to leave the call at any time. So let's talk about megatrends, a topic of interest to all of us on this call. I'm delighted to introduce you to our speaker for this afternoon, Rob Powell. He is Head of Thematic and Sector Strategy for BlackRock's Active Equities Group, as well as Lead Strategist for the iShares thematic range. Rob, thank you so much for joining us today. We are looking forward to learning more. Over to you.
Thank you very much, Helena, and thank you all, everybody on the line, for taking the time to listen to what we've got to say today. We really appreciate your engagement. So as Helena said, I work at BlackRock. I'm based in London, and I'm the head of thematic and sector product strategy for the firm. So have a real focus on megatrends. So what we're going to do today is to take you through some slides which cover 3 things, and I'm going to share my screen now on Zoom so that you can see the slides. These things are defining what megatrends are and why they're an interesting investment opportunity now. Talk about disruption that we see playing out right now, particularly the disruption of transport and how internal combustion engines are going to be rapidly replaced by electric vehicles in the next few years if our forecasts are correct. And then finally, we're going to look at what we see as the 5 key megatrends driving change in the world and leading and giving rise to very interesting investment opportunities for the next 10, 20 or 30 years. So if I can click through, what is megatrends investing all about? Well, firstly, it's about identifying a megatrend. A megatrend is a large-scale shift that affects everything that we do, from how we live, how we work, the kind of technology that we interact with. Something that is, and it's generally something that is happening on a global basis. So when we're looking to invest in these kinds of megatrends, we're doing so without the traditional country or sector boundaries that have driven investment decision-making in the past. We're not going to have themes or megatrends that are looking to access just China or just Europe, because we think that megatrends are playing out on a global basis as we become increasingly connected as global citizens. And then finally, we're looking to allocate disproportionately to the winners of these global megatrends. We're looking to overweight within portfolios the companies that we think can really benefit and win from the disruption that we see playing out in the world. So why do we do this? Well, at a company level, we believe that by allocating to companies that are aligned to megatrends, that these companies are going to generate above average earnings. So that means that they're basically going to be, we see that they're going to be more profitable over the long term because they are aligned to this long-term disruption. So taking electric vehicles, by example, we think that electric vehicle manufacturers are going to be way more profitable for the long term than internal combustion engine vehicles because of the challenges that internal combustion engine vehicle manufacturers are facing. And we like to focus on this area as well because we think that change is accelerating. We're going to see this later on, and we're going to see examples from the past in a moment. But we think that the pace of change within technology is reaching unprecedented levels that's set to continue for the next few years. And this is all playing out in a world where growth is harder to find. We've obviously seen a black swan event affecting global markets in the last few months. And we've seen massive volatility within equity markets. But there's been a key trend over the last few years where finding strong growth within equity markets is increasingly challenging. And we think that by allocating to companies that are very well aligned to megatrends, that you can find growth in this low growth world in which we all are operating in. We also think, as I already said, that this disruption is playing out across borders. We're not going to just be focusing on single countries or regions. We want investment products and propositions to be able to invest wherever the opportunities are most prevalent. Why is it relevant to give yourself an arbitrary boundary like a European equity boundary when you could be accessing interesting investment opportunities on a global basis? And we're doing this all with the aim of generating some outperformance against global equities. We want to be able to provide investment propositions that can really be additive within a portfolio context by leading to outperformance against standard, plain vanilla, market cap weighted global equity indices. And this begs the question, how do you actually invest in megatrends? Well, it's all about finding themes or long-term trends that are aligned to these drivers of disruption. And this is where some confusion sometimes comes in because the term investment theme is a well-written phrase that often appears in financial press. But we see that there are broadly two kinds of investment themes. The first is a cyclical investment theme. These investment themes are very short-term in nature and generally are driven by a view on where we are within the business cycle. They tend to be mean reverting. You're investing for over a 6 or a 12-month period, and they're driven by the things that you see along the top of this slide. So volatility, asset valuations, interest rates, currency values. This is all about taking a short-term view on where you believe markets are likely to move as an investor. And then there are structural themes. Structural themes are much longer term in nature. And they're all about a permanent change in the current economic environment. We're not looking for mean reverting themes, as in the case with cyclical themes. We're looking for a permanent change in the status quo. The shift from the internal combustion engine vehicle to the electric vehicle is a great example of this. This is something which is not going to revert. And we think that by allocating to these long-term structural trends, structural themes that are underpinned by the megatrends that we're talking about today, that you can reduce the impact of the business cycle and have long-term outperformance versus global equities. But this begs the question, given that we're inherently taking a forward-looking view on where markets are likely to move when it comes to megatrends, which trends have played out in the past and where have opportunities been that we can look at as evidence for this kind of shift playing out and having the kind of large-scale disruption that we're looking to capture within our portfolios. And a great example is the introduction of television. So in 1946, 0.01% of households in the United States had access to a television. We use data from the United States because this is the most readily available data that we have. And one of the rationales for allocating to structural shifts is that they're always or very frequently underappreciated by investors in the market. And that's our key rationale here, that if you invest in a structural shift that is beginning to accelerate, you are likely to generate above average returns because they are often underappreciated by investors and policymakers and consumers alike. So from 0.01% of households in the US having access to a TV in 1946, we saw a dramatic shift to 90% of households having access to a TV in 1960. So in just a 14-year period, we see this huge adoption of new technology. And this is exactly the kind of shift that we're looking to capture within our portfolio. And this isn't just affecting a single company. This is affecting whole industries. So yes, the television manufacturers did well, but think how the networks and the media operators did, and also the advertising executives and the advertising companies who suddenly could reach a nationwide audience, whereas before they were just constrained to very local audiences. So we're looking to capture these kind of shifts and the knock-on effects across multiple industries, which lends itself well to a broad, diversified exposure to a theme. And there's many different examples of this kind of disruption from other technologies. Here you just have technology adoption curves from first introduction to mass penetration, and how quickly these new technologies do take hold. From the fridge, the TV, the microwave, the internet, we see these hockey stick-like adoption curves playing out. And one that we find particularly interesting at the moment to look at, which I've already mentioned a couple of times, is the shift away from internal combustion engines more towards electric vehicles. And this is a great example where we believe that policymakers in particular are underappreciating the scale of the shift, and forecasters. And this is providing us with significant investment opportunities, despite this being a well-accepted shift that is starting to play out. So if we now add on OPEX forecasts for electric vehicle adoption over the next few years, you can see that the curves have a dramatically different shape, not hockey stick-like, very much flatter. And this was their forecast in 2017, and they've already had to up this forecast in 2018. And we expect that this curve to be increasingly hockey stick-like as consumers, as regulation, societal shift, and economic force take hold. And these three key aspects are what we look for in all of our themes. And all of our structural shifts that we're looking to capture driven by megatrends is the convergence of these three factors: regulation, societal change, and economic force. And when we look at this convergence with vehicles at the moment, you can see a really strong picture emerging when it comes to the pace of change and the disruption that we're expecting to play out. So regulation, what's happening when it comes to vehicles? Well, firstly, there's huge pressure on companies and vehicle manufacturers to have cleaner vehicles. So we're seeing a real downward path in emissions coming from vehicles. You can see on the red line there, the average CO2 emissions for vehicles has been on a downward path since the early 2000s, driven by regulation. But you see it flattening out in 2018. And you can just see from the yellow line how stringent the forward-looking targets are. And we think that this is going to be impossible for internal combustion engine vehicle manufacturers to meet these targets, which lends itself very well to electric vehicle manufacturers coming to the fore and being the most prevalent kind of vehicle that is going to be sold going forwards. So regulators are a key driver of this shift and a key driver of all of the shifts that we're looking to capture when it comes to megatrends investing. Secondly, societal force. Now, societal force is all about changing consumer preference and the views of the global society. And this is arguably the hardest to quantify. When it comes to electric vehicles, this is all about the perception of climate change when it comes to consumption. And we're seeing an increasing requirement for consumers, for companies to be climate aware. And this isn't just in the vehicle manufacturing space. This is across many different industries. We have slides like this in a number of our decks, where we used to be updating. We used to find new data points and new article entries every year or so, every couple of years. And we now find it easy to find new and relevant articles on a much more regular basis, because the pace of change and the focus on climate for investors is increasing. We've also seen what we refer to in Europe as the Greta effect. Greta Thunberg going around and raising the profile of all of these climate-related issues is having a huge impact on how consumers are behaving. And this is also a key shift or a key driver of the shift from internal combustion engine vehicles to electric vehicles, as consumers want to have vehicles that are emitting less carbon and are better for the global environment. So societal shift, a very important driver of interesting investment opportunities when it comes to investing in megatrends as well. And then finally, economic shifts and economic forces. So this is all about it becoming impossible for consumers and manufacturers or product providers to avoid the potential of these kind of themes, because it's becoming economically way more attractive for them to be involved in the disruption than in the incumbent industry. And when it comes to electric vehicles, it's all about battery costs. You can see that just in the decade between 2010 and 2019, we've seen a massive drop in the cost of batteries that go into electric vehicles. Batteries account for around 40% of the overall cost of an electric vehicle. So if we see falling battery costs, we see those falling costs passed on to the consumer. Many forecasters expect that by 2025, we're going to have battery costs below $100 per kilowatt hour, which is the magic tipping point when electric vehicles are going to become cheaper to run and to purchase than internal combustion engine vehicles, making it extremely or increasingly viable for consumers to purchase an electric vehicle versus an internal combustion engine vehicle. So when we see the convergence of these three kinds of shifts, we see strong opportunities for structural change, and we expect the disruption to accelerate, beating the underwhelming OPEC and policymaker forecasts and becoming much more hockey stick like an exponential in terms of the rate of growth of change within a theme. So what are the 5 key megatrends that we have that we believe are the most important drivers of change? Well, what you see on this slide is BlackRock's view on what the most important drivers of change in the world are going to be over the next 10, 20 or 30 years. So climate change and resource scarcity, our first and arguably largest scale megatrend or most relevant megatrend of the moment. When we first wrote our research on megatrends, we had a statistic, a slightly alarming statistic within that white paper, which was that between the year 2000 and 2016, we'd seen 15 of the 16 hottest years ever recorded. In 2017, we had to revise that number to have 16 of the 17 ever hottest years on record. In 2018, we had to do the same thing, and in 2019. It remains to be seen whether we will have to revise the number for 2020. We're obviously living in an extremely challenging time where we've had global lockdowns driven by the coronavirus pandemic, but global temperatures have been on an irreversible path. A slightly alarming statistic that I also read about temperature changes is that we've reduced, by being on lockdown, we've reduced carbon emissions globally by around 5.5%, which is a relatively small number given that there are so many fewer planes in the sky and cars on the road at the moment. The Paris Climate Accord and the World Economic Forum believe that for us to reach the 1.5 degree target that they've put in place in terms of global temperature rises from pre-industrial levels, we have to reduce global temperatures by 7.5%. Global carbon emissions, by 7.5% every year between now and 2030 to even come close to achieving that target. So despite the global lockdown, there's still a huge amount more to do. But we're looking for the positive changes that are going to result from megatrends like climate change. We've already seen the electric vehicles theme, which is a key, which is one of the key drivers of this theme is the climate change and resource scarcity megatrend. Secondly, demographics and social change. So this megatrend is all about large-scale changes in global population dynamics. And a key change that we're monitoring here is the global aging population. And there's some startling statistics on this as well, because in 2019, it was the first year where there were more 65-year-olds in the world than people under the age of 5. So we already have a very aged population globally. And we expect this shift to continue to play out. The UN believe that there's only one country in the world where over 30% of the population is aged 60 or older, and that country is Japan. They also believe that by 2050, there are going to be 55 countries where 30% of the population is over the age of 60. If we look at China specifically, which is one area where we see a hugely aging population, which is massively underappreciated by most investors who believe that this is a Western or predominantly American theme that is playing out, there are already 20 million people in China over the age of 80. And the UN believes that by 2050, there are going to be 120 million people over the age of 80 in China alone. So I believe that's double the population of South Africa just in people over the age of 80 in China. So very much a global problem here. But again, we're looking to focus on the positive aspects of this kind of shift. So can we over-allocate to healthcare companies that are treating chronic diseases that become increasingly prevalent in old age? Or can we invest in aging leisure companies, which are very well aligned to changing consumer behavior as people get older? Technological breakthrough, we've already touched on quite a bit in the presentation, but this is about the pace of change in technology. We believe that change within technology in the past has happened in a linear fashion. And some people often say to us that having technological change or technological breakthrough as one of the key megatrends is a bit of a cop-out. But the way that we see it is that it's an enabler of all of the other megatrends that we have here. And we see that exponential growth and exponential change is going to be playing out within technology. If we look at all of the kids who, by way of an example, if we look at all of the kids who are currently entering primary school, so 6 and 7-year-olds who are starting schooling at the moment, and we fast forward until they're 21, so in 15 years or so, forecasters believe that 70% of those kids, when they're entering the workforce, will have jobs that don't currently exist today, because disruption of existing industries and technological change will mean that many of the existing jobs are simply obsolete. So this is a key shift that we're monitoring and something that we see as an enabler of all of our other 5 key megatrends. Rapid urbanization is all about the mass migration of people from living in rural areas to living in urban areas. This has been a steady shift that we've seen playing out over the last 20 years or so, but one that is really starting to accelerate. And again, this is happening predominantly within Asia. We already know that there are 100 cities in China with populations of over 1 million people. Now that compares to 8 cities within the United States, just by way of context. So China is already a massively urban society. Shenzhen, the 4th biggest city within China, had a population of around 30,000 people in the late 70s. It's now got a population of 14 million people. So we've seen massive urbanization of that society already, but we expect this to continue, and at an alarming rate. So from 100 cities with populations of over 1 million today, we expect that by 2030, there are going to be 200 cities within China with populations of over 1 million people. And again, despite the slightly scary sounding statistics, there's some hugely interesting investment opportunities that we can look to capture by focusing on this trend. So the infrastructure requirement of building these new cities and the different kind of infrastructure that is going to be required for modern city dwellers is going to be way more connected, way more tech-enabled than the older cities that most people in the world currently dwell in. And finally, changing economic power. This is all about the emerging global wealth. So an increasing proportion of GDP coming from the currently emerging markets of China and India at the expense of the US. And there's some amazing statistics here about growing middle classes. So 150 million people enter middle classes every single year, and have those changing consumer preference that happens when people enter the middle class in terms of increased focus on leisure. And 90% of those new middle classes are coming from Asia. Another statistic that I saw that I really liked on this recently is that China mints 2 new billionaires per week. So there's an increasing opportunity for populations within Asia, in India and China particularly, to drive this shift of global economic growth away from the United States and Europe and more towards the currently emerging markets. And this is why we focused on, at the start of the presentation, the description of all thematic and megatrends investing needing to be unconstrained. We want our investment propositions to be able to invest wherever the opportunities are most prevalent. So just to sum up, we believe that megatrends are the most important drivers of disruption within the world. And that if we focus on investment themes that are driven by these megatrends, that we can really add value in a portfolio context and generate some outperformance versus standard global equity markets. Thank you.
Thank you, Rob. Thanks, Rob. Having listened to you, it reminds me of a quote in your report: "The future is getting here faster." And even more so with COVID. Yuval Harari also described it very well. Pandemics fast forward history. That's quite scary, but fascinating at the same time. Megatrends have been around for a while, but now seem to be accelerating. So before we start with the questions, and there's a couple of them, so be ready. Let's do a quick poll. You should see the question coming up on your screen now. You can pick more than one answer. So which of these mega trends will be most affected by COVID-19, in your opinion?
That's interesting. It seems like there's people are focusing on the positives here, which is brilliant. So yeah, quite an interesting split emerging between technology, demographics, changing economic power. Yeah, I think that technology is a key area that we're looking at the moment in terms of seeing this acceleration driven by acceleration of these technological breakthroughs driven by COVID. There's many tech CEOs who are coming out and talking about how we've seen 2 years worth of disruption within 2 months driven by COVID. So that's very interesting that everybody's aligned on that front. Demographics and social change. I'm not sure how COVID is going to speed that up. I suppose we're going to have a huge focus on healthcare going forward, driven by increasing R&D spend when it comes to looking for a vaccine, and we have seen an increase in focus there, and changing economic power. Interesting as well. Potentially, maybe people voting for that one based on the negatives, given that there's a lot of news flow coming out at the moment about the relations between the US and China and how COVID has driven change there. Our view on that front is that long term we don't expect significant impact on globalization, because we think that the consumer forces are too strong when it comes to providing opportunities for businesses to operate in those areas.
The one I'm surprised about is the rapid urbanization, only 9%. So maybe I can ask you a question before I go to the audience questions. That has been a significant mega trend over the last couple of years. And up to now, I don't think we've ever questioned the direction of the momentum. Super cities are economic meltpots after all. But one of the many learnings from COVID-19 is something that tech companies probably have known for years now. Virtual work is effective, and a large part of the professional workforce can actually work from home. By definition, that actually opens up your choice of home. Once people might be able to work for a big corporate in a city like Cape Town or New York while living somewhere in the countryside. Do you think this might have an effect on urbanization at all as a megatrend, or will it simply redefine the concept of smart cities?
I think that's a great question, and one that we have debated extensively because of all of the great rationales that you've highlighted there. Our view is that the pull of the cities is too strong. So, I mean, the reason that people are moving to cities is, better healthcare outcomes within cities, more employment opportunities, better living conditions, effectively. And we think that this pull is going to remain, despite the potential for people working virtually. I saw a statistic about virtual working in the United States, which said that only 1 in 5 jobs currently could be done virtually. This may change through time, but it does just show that you are still needed many workers still need to be present when it comes to work. So we think that the urbanization trend, despite potentially a little bit of a blip driven by COVID at the moment, is going to continue when we're through the worst of the crisis. In terms of areas where we've seen positive impact and acceleration driven by COVID, there are really 3 key areas that have emerged. So the first is technology, and you already alluded it to it there, Helena. That increasing adoption of virtual working and digitalization of many processes has really accelerated this. COVID has really accelerated shifts in those directions. And it's not just virtual working, it's the reduction in the usage of cash and the potential for fintech companies who are operating in that space. And we've seen strong performance for technology-related themes. The second area won't come as that much of a surprise either, and it's healthcare. We've seen this. We've seen a huge emphasis from investors, particularly European investors, on healthcare and companies that have high R&D spend. So companies who are looking for vaccines or looking for new technologies that are going to be disruptive within healthcare. We've long been tracking healthcare-related themes because of the global aging population and the increasing requirement for spending on healthcare as people get older. But again, we think this has been accelerated by COVID. And there's obviously some convergence, like I was talking about before, between technology and healthcare in terms of the drivers of those shifts. So we see more technology-focused healthcare companies as being the beneficiaries of COVID predominantly. And then the last one, which may come as a bit of a surprise for some of those on the call, given the votes that we just had, is climate and climate-related themes. We've seen a real resilience in companies that have low carbon emissions, for example, and who score well when it comes to environmental scoring and environmental aspects of investing through the crisis. And we expect to see an acceleration of the reallocation of capital towards companies that are both defensive in terms of providing exposure to companies that benefit when the sun shines or when the wind is blowing, but also are very much aligned to this long-term structural shift and the societal preference for companies that aren't negatively affecting the climate. So yeah, 3 key areas of positivity accelerated through COVID: technology, healthcare, and climate-related exposures.
there seems to be a lot of questions around investments coming through as well. So here's one that I would like you to answer. These trends seem rather consensus. So could it be already reflected in asset prices? So yes, some of that, like technology, they are accelerated, but most of these things are trends that we're already familiar with. Is it that it's priced in already?
Well, I think that's why I wanted to show earlier on the OPEC forecasts of electric vehicle adoption, because despite there being this huge acceptance that lots of these shifts are going to be playing out, we see a big underappreciation of the potential for the disruption. If we look at solar installations, for example, as a disruptor of fossil fuel power, and we look at forecasts by the International Energy Agency, over the last decade, they've had to increase their forecasts for solar installations every single year, and we've reached their 2030. We reached their 2030 target a decade early for the solar installations, showing that despite it being a well-accepted fact that we're going to have to replace fossil fuels and that they're going to become increasingly uneconomical in future, there's massive underappreciation from the people who are meant to know most about it, as in the forecasters. And we see this aspect as providing huge amounts of investment opportunities.
Now, there are a couple of questions here actually addressing a more practical question. How do you capture these factors? How do you actually capture it in a factor in a fund? So it sounds like investing in any of these mega trends is really about investing in multiple sectors of the economy. So maybe is this correct, but also what is the representation of these mega trends in broad market indices like the S&P 500 and the world indices?
I think that's a great question, because generally the rationale here, or what we're looking to capture, is companies that are currently underrepresented within global equities, given the forward-looking potential for the technologies that they're bringing. So if we look at the top 10 largest positions in the MSCI World Index or the S&P 500 Index, if we look at the top 10 today and we look at the top 10 10 years ago, we'd see a very different picture. If we go 10 years before that, we'd see a different picture again. So what you're doing by investing in plain vanilla global equity indices is over allocating to companies that have already grown significantly and become the biggest companies in the world. What thematic investing is all about is over allocating to companies that currently form a smaller part of global equity indices, but are going to become much more important aspects within all portfolios. So to use a sporting analogy, I heard somebody describe this as, it's good players are where the ball currently is now. If you're playing soccer, for example, the great players are where the ball is going to be. And that's what thematic investing is all about. It's about trying to predict where global equity indices are going to move towards, driven by disruption, and over allocating to the drivers of that disruption.
Are you missing your sport, Rob? So here, the next one is, there's a lot of ESG questions coming through as well, and how you captured that. So if you look at the change, your fifth mega trend, if you look at the change in economic power from the west to the end, there's a new philosophy out there, moving the world to a more sort of a collective way of thinking rather than that of the individual. And I think that is very much reinforcing economic and social sustainability. So in your view, does this accelerate ESG as an integral part of the investment decision rather than just a theme? So it's actually becoming more important than just a theme.
Short answer, yes. We think that companies who score favorably from an ESG perspective are likely to be rewarded on an ongoing basis by investors. we're definitely seeing a massive convergence between sustainable investing and investing in megatrends. Obviously, we have climate change and resource scarcity as one of our key megatrends, but we see an increasing number of investors who are looking to over-allocate to companies that are both driven by the shift towards ESG, but can also make a positive impact and contribute positively towards an increasing shift. So electric vehicles is a great example because it's driven by climate change, but it's also by investing in the theme, you're potentially accelerating the shift towards electric vehicles at the extent of internal combustion engine vehicles, which is going to be positive for climate change. So it becomes self-fulfilling. So yes, we definitely do see companies that have strong ESG scores being increasingly rewarded in future.
So here's a difficult one, and I'm going to combine a couple of questions here. How do you know which companies will be the winners? So if you knew that, that will be fabulous. Rob, Betamax versus VH is Apple versus BlackBerry. And I want to continue with another question there, Ad. If you look at a range of firms, if you look at the COVID crisis, a range of firms across themes like pharmaceuticals are said to benefit rather than a single company or stock, because it's nearly impossible to identify which one will be the winner actually. Does it mean that theme-based funds should take preference over, say, more broad-based indices and very concentrated active funds?
So I think that's one of the key questions when it comes to thematic investing is why would you not just buy a single stock that you feel is really well aligned to the kind of disruption and the shifts that we're talking about? And one of the key reasons is company level risk. There may be one electric vehicle manufacturer in the world that is very high profile and that is at the top of, that is one of the larger companies in the world that has been a very strong performer. But that company is very well, I don't think I'm allowed to talk about individual company names, but that company has a CEO who is very well recognized, and his actions often have very significant effects on the share price of that company, causing massive volatility at times. So the rationale with thematic investing is that if you can capture exposure to a theme across a value chain, so you're not just investing in an electric vehicle manufacturer, for example, you're investing in the battery manufacturers or the parts manufacturers that go into a car. There are 15 times more semiconductors in an electric vehicle than there are in an internal combustion engine vehicle. So you can see the potential opportunity there way down the value chain. If you can invest across the value chain and capture the theme like that, then you reduce the idiosyncratic risk associated with investing in a single company whilst retaining your exposure to that long-term disruption which you see playing out. So yeah, it's the trade-off between potentially extremely large returns in single companies, but significant volatility. And when I say extremely large returns, you could also have extremely large losses, versus investing in the value chain for a theme where you're more likely to have a smooth, or we hope you're more likely to have a smoothed outcome and reduce the idiosyncratic risk while retaining exposure to the disruption.
Thank you so much, Rob, for your input. Unfortunately, we are running out of time. We're on 2:00, so we'll have to leave it here. But thank you so much. And also thank you to all the participants. We've had a couple of questions here, very interesting, and I'm sad that we didn't get through all of them. But please look out for the recording of our webinar if you would like to re-listen to it. And also for the invite to our webinar on China. Stay safe.